Most traders begin their journey believing success lies in finding the perfect strategy. Indicators are tested endlessly. Entries and exits are optimized. Charts are studied late into the night. Yet after months or years of effort, results often remain inconsistent. This leads to an important realization. Trading success is rarely limited by strategy. It is limited by psychology. Two traders can use the same system, the same indicators, and the same market conditions, yet produce completely different outcomes. One trader grows steadily. The other struggles, despite having the same technical knowledge. The difference is not intelligence. The difference is not access to information. The difference is mental discipline. Trading is a performance activity, and performance is deeply connected to emotional control, decision-making, and risk management. Understanding this mental side is what separates short-term excitement from long-term consistency. The illusion of the perfect strategy. The trading industry strongly promotes the idea that one perfect strategy exists. Social media, advertisements, and online courses reinforce this belief. Every losing trader is encouraged to search for something new, a better indicator, a smarter entry, or a secret formula. This creates a dangerous loop. A strategy works briefly. A losing streak appears. Confidence collapses. A new strategy is adopted. Over time, traders accumulate strategies but never master execution. The truth is simple. Most strategies fail not because they are bad, but because they are applied emotionally. Markets are uncertain by nature. No strategy wins all the time. When traders expect certainty from a probabilistic system, emotional reactions become inevitable. Same strategy, different results. Consider two traders using the exact same strategy. Both see the same setup. Both enter at the same price. Both place similar stop losses. Yet when the market moves against them, one trader accepts the loss calmly. The other moves the stop loss. When the trade moves into profit, one trader follows the plan. The other exits early out of fear. Over time, these small emotional decisions compound into drastically different results. The strategy did not change, the mindset did. This is why trading performance cannot be separated from psychology. Emotional control, the core skill in trading. Every trader experiences emotions. Fear, greed, excitement, frustration, and doubt are natural responses to financial risk. The goal is not to eliminate emotion, but to prevent emotion from controlling decisions. Fear in trading. Fear usually appears in two forms. 1. Fear of losing money. 2. Fear of missing out. Fear causes early exits, hesitation, missed opportunities. When fear dominates, traders protect short-term comfort at the expense of long-term results. Greed in trading. Greed often appears after winning streaks. Confidence turns into overconfidence. Risk increases. Greed causes overtrading, ignoring risk limits, chasing profits. Greed convinces traders that the market owes them more. Revenge trading. Revenge trading is an emotional response to loss. Instead of accepting a losing trade, frustration demands immediate recovery. This leads to oversized positions, poor setups, and rapid account damage. Revenge trading is not a strategy problem. It is an emotional reaction to discomfort.
The market does not change. Traders do. Markets are neutral. They do not reward or punish individuals. They simply move based on supply and demand. What changes from trade to trade is the trader's emotional state. A calm trader follows rules. A stressed trader breaks them. A disciplined trader accepts losses. An emotional trader fights them. This is why psychological consistency matters more than market conditions. Risk control as psychological protection. Risk management is often described as a technical concept. In reality, it is psychological protection. When risk per trade is small, losses feel manageable, fear decreases, decision-making improves. When risk is too large, emotions intensify, logic disappears, mistakes multiply. Professional traders understand that psychological stability begins with position sizing. Risk control does not limit profits, it protects discipline. Why knowledge alone is not enough. Many traders know exactly what should be done, but fail to do it. Rules are written clearly. Follow the plan, respect stop losses, trade only valid setups. Yet, under pressure, knowledge disappears. This happens because knowledge lives in logic, while trading decisions often happen emotionally. When stress increases, the brain prioritizes survival instincts over rational thinking. Training the mind, therefore, is just as important as learning technical analysis. Consistency is a psychological achievement. Consistency is misunderstood. It does not mean winning every day or avoiding losses entirely. True consistency means executing the plan repeatedly, accepting normal drawdowns, avoiding emotional extremes. A consistent trader may experience losing weeks but avoids destructive behavior. This allows the edge of the strategy to play out over time. Consistency is not exciting, it is stable, and stability is profitable. Discipline over motivation. Motivation is emotional and temporary. Discipline is structured and reliable. Motivation says, trade more. Discipline says, trade better. Motivation fades under pressure. Discipline remains when emotions fluctuate. This is why successful traders rely on routines, rules, and preparation rather than feelings. The role of patience. Patience is one of the most undervalued skills in trading. Markets spend more time doing nothing than moving clearly. Many losses occur not because of bad analysis, but because of boredom. Impatience causes forced trades, low-quality setups, unnecessary risk. Patience protects capital and mental clarity. Waiting is not inactivity, it is discipline in action. Losses as part of the business. Losses are inevitable. They are not a sign of failure. They are a cost of participation. Traders who fear losses tend to avoid valid setups, move stop losses, hesitate. Traders who accept losses remain calm, execute consistently, protect capital. Acceptance does not remove pain, but it prevents damage. Emotional awareness in trading. Emotional awareness means recognizing emotional states before acting on them. Common warning signs include urge to recover losses quickly, increased trade frequency, ignoring rules. Awareness creates a pause. The pause creates choice. Choice creates discipline. Without awareness, emotion becomes action. Why simplicity improves psychology. Complex systems increase mental pressure. Too many indicators create confusion. Confusion creates hesitation. Simple systems reduce decision fatigue, improve confidence, support discipline. Simplicity does not reduce effectiveness, it improves execution. Long-term thinking versus short-term emotion. Trading rewards long-term thinking. Emotions focus on immediate outcomes. Short-term thinking asks, did this trade win?
Long-term thinking asks, was the process followed? Shifting focus from outcomes to process reduces emotional volatility. Building a trading identity. Consistent traders view themselves as risk managers, not gamblers. This identity shift changes behavior. Capital becomes a tool, not a toy. Losses become data, not insults. Wins become feedback, not ego boosts. Identity influences decisions more than rules alone. Mental fatigue and overtrading. Mental fatigue lowers discipline. Overtrading often occurs late in sessions or after emotional events. Recognizing fatigue is critical. Rest is not weakness, it is risk management. Environment matters. The trading environment influences mental performance. A cluttered space increases stress. A calm setup supports focus. Small changes in environment can improve emotional stability. Emotional neutrality as the goal. The goal is not excitement. The goal is neutrality. Neutral traders do not celebrate excessively, do not panic during losses, execute consistently. Emotional neutrality allows probabilities to work. Why mastering the mind takes time. Mental discipline is built through repetition, not inspiration. Mistakes are part of learning. Awareness improves gradually. Consistency develops slowly. There are no shortcuts to psychological mastery. The real edge in trading. The real edge is not secret knowledge, it is emotional consistency. Most traders know what to do. Few can do it consistently under pressure. That ability is the edge. Trading success is not defined by the complexity of a strategy. It is defined by the ability to execute under uncertainty. The market does not require perfection. It rewards discipline. By controlling risk, managing emotions, and focusing on process rather than outcome, traders create the conditions for long-term consistency. Winning trades feel good, but disciplined behavior creates lasting results. Trading is mostly mental, and mastering the mind is what turns strategies into profits.
This channel focuses on treating psychology and discipline. Subscribe if this perspective is useful.